So the only good thing I can say about the market last week is that it's finally over. Now, most of megacap tech reported, and we are starting to get to some interesting levels, so let's talk about it. First off, let's start with megacap tech earnings, which were split. Netflix, Microsoft, and Amazon received positive market reactions, while Google, Meta, and Tesla not so much. These earnings weren't disastrous, but it's really showing the market sentiment at the moment. Now, with the war in the Middle East, rising interest rates, and stocks that have had pretty good runs, it's a shoot first, ask questions second kind of market. Now, all eyes will be on Apple reporting next week, and this will have a huge impact on the Qs, no doubt. Now, Apple has traded down, so expectations are low, and I feel we could be setting up for an Amazon or Netflix type reaction. We are currently down 12% from the July high and up about 30% year to date. We are approaching the 200-day moving average, which coincides with the key swing level of 335. Now, we are almost oversold, and I feel that we can bounce, but until rates stop increasing, it's tough for the market to have a sustained rally. Earlier this week, Bill Ackman tweeted that he covered his long-standing bond short, which I guess is a bit of good news, but interpret that however you choose. We are in a corrective downtrend, and before we can get bullish, we need to see a change in market structure. That means to stop making lower lows and begin to make a higher low to show that the market has at least stopped going down. If we take a look at the bear market of 2022 and how that ended, we kept making a series of lower lows until the market found support around 260. We didn't make a new low, we retested, printed an RSI divergence, and the bottom was in. If the 200-day moving average doesn't hold, the next level of major support is around 310. This would line up with the 200-week moving average and the January swing high. This would coincide with a fib retracement to the golden zone, which is typically where I like to buy pullbacks, and put us down 20% from the July high. And if rates are going to 6% like many are calling for, this scenario seems very likely. Furthermore, if we take a measured move of this head and shoulders top from the neckline to the top of the head, that's 32 points, and that would put us down roughly to that 320 level, and the 200-week moving average would probably catch up by the time we get there. We have to remember that the Qs are up a lot this year, and we are simply correcting some of the excesses that have built up in the market. Now, the Fed is approaching the end of their rate increases, which opens the door for the inevitable rate cuts sometime in 2024. Now, just be patient, dollar cost average into your favorite stocks, sell covered calls for additional income, and this too shall pass.